Welcome to my YouTube channel where I study the best investors from around the world. Today we're going to be going through the strategies that Warren Buffett recommends for investing in stock in 2021. Gear up and get ready to get the tips and knowledge from the world-renowned stock investor Warren Buffett. Warren Buffett, the American business magnate, chairman and CEO of Berkshire Hathaway, and the world's living best investor, built his fortune by analyzing individual businesses and buying them at discounted prices. His strategy can essentially be summarized by just waiting and waiting and waiting until you get the perfect opportunity to buy at the right price. Then, when he's got the opportunity to buy a great company at a discounted price, he buys heavily, and then he aims to hold that stock over several decades. Buffett's strategy involves three key factors: waiting for the right opportunity, investing heavily when the opportunity presents itself, and holding the investment or stock for a very long time. This strategy has led him to buy into businesses such as Coca-Cola, Apple, Bank of America, and American Express, and all of these positions have done remarkably well for Buffett over the years. However, despite all of these strategies, the key to Buffett's success is his temperament.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all.
No, I mean, what are dumb things? Selling a stock because it goes down?
Selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business.
I think that there's a lot of value in this line of thinking. The world's best stock picker says if you don't have the right temperament, don't even try to do what he does. And I know this talk of having the right temperament or how it's so important sounds a little bit wishy-washy, but it's actually true. The main reason investors that pick individual stock lose money is not because they don't find a great business. Most people do find a great business to buy. The reason that they lose money is that they get influenced by their emotions. They end up buying and selling those great businesses in completely the wrong times due to impatience or price dwindling. So what do you do if you want to be an investor, but you quite simply can't keep your emotions in check? Well, luckily for you, over the past few decades, there has been a stock market. There has been an investing approach that has gained tremendous popularity. That is, of course, passive investing through ETFs or through index funds. It's essentially where you buy one stock and that stock actually represents wide diversification. In a lot of instances, it represents diversification across the whole market. So the idea here is that you just show up each and every year and you continue to buy into the market, rain, hail, or shine, and you show up every single year. You do that year after year for several decades, regardless of how the market is reacting, and that takes the emotion out of investing. You're not trying to pick the right times to buy in and out, and you're not trying to pick the right companies to buy in and out of. Instead, you're just backing the market in general, showing up each and every year over a long period of time, and that means that you're going to get about average of the average market return. And here's the catch. This approach is the stock market approach that Warren Buffett, the world's best active investor, recommends for most investors. Buffett is quoted as saying, "So this time I went back actually to 1942 when I bought my first stock as an illustration. Of all of the things that have happened since 1942, we've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars, we've had 9/11, we had the Cuban Missile Crisis, and we've had all kinds of things. The best thing that you could have done on March 11th, 1942, when I bought my first stock, was just to buy an index fund and never look at a headline and never think about stocks anymore. Just like you would do if you bought a farm. You just buy the farm or let a tenant farmer run it for you. And I pointed out that if you had $10,000, it amounted to $51 million now, and the only thing that you had to really believe in is that America would progress as it has ever since 1776. And that American businesses, if America moved forward, would move forward too. You don't have to worry about what stock to buy. You don't have to worry one day to get in and out and didn't know the Federal Reserve would exist. Whatever it might be. Believe me, America works. This is why Warren Buffett likes to recommend this strategy. It takes the psychological aspect out of investing. It takes away the need to have that right temperament. You don't need to know about what stocks to buy. You don't have to worry about what day to get in and what day to get out, and it still produces great results if you give it time, and that's really the second big thing to successful investing. Again, I want to emphasize Buffett's strategy, which involves 3 key factors: waiting for the right opportunity, investing heavily when that opportunity presents itself, and holding that investment or stock for a very long time. Because there may be some periods of time where the market goes nowhere for like 10 years. For example, from 1966 to 1978, the market did nothing. You got a 0 return. But if you just held it for another 10 years, all of a sudden, you've got a total of 187% return and compound annual growth rate of 5%. So 12 years for 0 or 22 years for 187% total. So it's a strategy that works consistently if you go the journey with your dollar cost averaging. And here's Warren Buffett talking specifically to that point. Here are Buffett's thoughts on dollar cost averaging. He says, "So I would pick a broad index, but I wouldn't toss a chunk into it in any one time. I would do it over a period of time, because the value nature of index funds is that you're saying, I think America's business is going to do well over a reasonably, over a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times." There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally, I think I know enough to pick the winner, but not very often, and I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that businesses are reasonable place to have your money over a long period of time, is invest over a long period of time and not make any bet implicitly by putting a big chunk in any given time. So remember, dollar cost averaging is the way to go because it protects you from 2 different things. Firstly, it protects you from your own emotions, and secondly, it protects you from market-wide swings. There will be quite drastic market-wide swings, but if you hang in there for a long period of time and you continue to show up each and every year, slowly but surely, you're averaging out at that average market return. So work out your plan, keep showing up year after year, decade after decade, and overall, that's why Warren Buffett likes this strategy so much and is so quick to recommend it even before he recommends his own investing strategies. And he's held this opinion for a long time too. This is an excerpt from his 1996 annual letter to shareholders where he said, "Most investors, both institutional and individual, find the best way to own common stocks is through an index fund that charges minimal fees. Those following this path are sure to beat the net results, after fees and expenses, delivered by the great majority of investment professionals." And it's true, if you follow this approach, the evidence shows that you're likely to beat the 70 to 80% of actively managed funds that are run by professionals. If you have a look here in the US, 78% of active funds haven't beaten the S&P 500 over the last 5 years. In fact, Warren Buffett was so sure that active funds would underperform index funds that he made a $1 million bet with protege partners that over a 10-year period, a hand-picked selection of hedge funds would underperform the S&P 500, and sure enough, Warren Buffett won easily. Warren Buffett has even recommended buying index funds to Lebron James. Here's Warren Buffett's exact quote to Lebron James.
I think somebody like LeBron, and we've talked about it, but I think...
You and LeBron have talked about it?
Occasionally. I think actually if through the rest of his career and beyond in terms of earning power then, just making monthly investments in a low-cost index fund makes a lot of sense. I think that somebody in his position ought to have a significant cash reserve and whatever makes them comfortable. And then beyond that, owning a piece of America, a diversified piece, bought over time, held for 30 or 40 years, it's bound to do well. And the income will go up over the years, and there's really nothing to worry about.
So there you go. Warren Buffett, the world's best stock picker, recommends passive investing for most people. No, he doesn't believe that it's the best strategy to make money, otherwise he would have followed it, but he does think it's the best strategy to make money for most people, and quite simply, the reason for that is it takes away a number one factor that kills active investors time and time again. When you're a passive investor, you don't need the right temperament. You just need to commit a dollar cost averaging strategy, and then you just need to keep showing up. Well, investors, that's it for this video. We've talked about the best passive investing strategy and how to get started with it. We've talked about the keys to successful investments is having the right temperament and waiting. Just allow the ETFs to grow by giving it a lot of time. Also, it is worth noting that dollar cost averaging passive investing is the way to go because it protects your emotions and it protects you from large market swings. So thank you very much. Please like this video if you enjoy the information shared. Comment and subscribe to this channel if you haven't done so already. And thank you once again. See you in the next video.